to protect their currencies, they have to come up with something better. And I think the only way they can do that is to go back onto some sort of metallic standard. And I think this is why, strategically, central banks have been dumping dollars to buy gold because, they know that's the way it's got to go. You've got to secure the value of your own currency. Only way to do that is to have a gold exchange standard. Now, whether they do it correctly or not, I think is too early to tell. My guess is that they won't do it correctly.
Gold is not necessarily in a bull market. Rather, fiat currencies are in a bear market, losing purchasing power against gold across all major economies. In recent years, gold's appeal has grown. While it took 12 years for gold's price to increase from $1,000 to $2,000 an ounce, a mark reached in 2020, it took only another 5 years to break the $3,000 barrier. In its report, JP Morgan named gold a top bullish pick for the third year in a row and asked, "Is $4,000 in the cards?" Respected economist and head of research at GoldMoney, Alasdair Macleod, explains that while the dollar is useful for trade, holding it long-term is risky. He believes countries like China and Russia are moving away from the dollar and accumulating gold. This, he suggests, points to a coming shift toward a gold-backed system. BRICS nations have strategically accumulated gold reserves, with Russia and China leading this trend. China's reported gold reserves have increased significantly, though many analysts believe actual holdings substantially exceed official figures as the nation prepares for a more gold-centric monetary system. Market analyst Alasdair Macleod points out that Trump's interventionist policies, especially tariffs, have shaken foreign investor confidence in U.S. assets. U.S. stocks rallied, but soaring overnight Treasury yields suggest China may quietly sell U.S. debt in response to new tariffs. With bond markets flashing warning signs while Americans sleep, investors risk missing a major shift. In the middle of chaos, Macleod notes that central banks and sovereign wealth funds are shifting from dollars to gold. Regarding the U.S. economy, Macleod warns that higher interest rates will deepen the debt trap as revenues shrink amid a likely recession. He notes that foreign governments recognize this, shifting to gold as the dollar weakens. After a historic first-quarter rally, gold is making new highs while the U.S. dollar breaks below 100. Investors are flocking to safe havens as global markets spiral deeper into uncertainty. Before diving into Alasdair Macleod's sharp insights from his latest interview, hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets. Let's get into it.
I think there is a broader question now that you've got Trump in there and you've got this tariff policies and all the rest of it. From the point of view of foreign investors, foreign holders of dollar assets, treasuries and corporate bonds and also equities, there's not much point in buying any more. So, given that quite a lot of government's funding has depended on foreign demand for bonds, this, I think, creates an immediate headache. And this is why Scott Bessent, I think, turned around and told Trump, look, you're going to bankrupt us if you go on this rate. So, you back off, mate. And I think that's basically the conversation that occurred. So, as far as the future is concerned, I think what we've got to look at is what level of interest rate is going to encourage foreigners to hold on to dollars. Now, effectively, the foreigners will be looking at the dollar, and particularly since it's broken down against all other currencies. I mean, the trade-weighted chart looks absolutely frightful. It's broken down. They know this. The reason they've been buying gold is because they've been selling dollars. I mean, so that foreigners are already attuned to this. When I say foreigners, I mean the central banks, the sovereign wealth funds, the really big money which is close to government, which is part of the debate, if you like, in whatever country. They know this has been happening. So they're not going to buy. Unless they get a return, which is commensurate with how they see the purchasing power of the dollar dropping. They're going to need it as compensation. But the problem is that the higher interest rates go, the worse it is for the US government because they're in a debt trap. And the debt trap is even more stark because as a result of President Trump's tariff policies, there is absolutely no doubt that the US economy is going into recession. Now, if that happens, then the tax base to cover the constant accumulation of government debt, as is, apart from the additions to it from the budget deficit, is just not going to be there. And so they are in a debt trap. The debt is accelerating faster than the ability to pay it off or to just control it, if you like. Foreigners know this. They're not stupid. And this is actually why gold appears to be rising. It's not so much gold rising, it's the dollar going down. It's foreigners getting rid of dollars. That is the key to understanding what is actually going on. So interest rates and bond yields, I think you can kiss goodbye to lower interest rates in 2025. And as soon as the markets realize this, there's going to be all hell to pay. I think there are two different problems here. I mean, the first one, international trade, that depends on dollar credit. When you buy goods, whatever, when you transfer goods across borders, then you use dollar credit. Okay, and once you've transported it, the credit is extinguished as far as you're concerned. Someone else has the problem. So that I think is one thing, and that is not a huge great problem. It doesn't matter what the value of the dollar is, so long as you don't hold it in the process. You just use it, rather like people sort of think Bitcoin can be used, if you like, to do a transaction. So that's one thing. The other thing is that you've got your own currency, and in a world which fiat currency world where the dollar is the reserve currency, you end up going down with the dollar unless you protect your own currency. And so that, I think, is probably the most important point as far as China, Russia, India even, and also a plethora of countries in Africa. So to protect their currencies, they have to come up with something better. And I think the only way they can do that is to go back onto some sort of metallic standard. And I think this is why strategically, central banks have been dumping dollars to buy gold because, they know that's the way it's got to go. You've got to secure the value of your own currency. The only way to do that is to have a gold exchange standard. Now, whether they do it correctly or not, I think is too early to tell. My guess is that they won't do it correctly to begin with. They'll probably go and try and sort of do a Bretton Woods thing where they say, well, the yuan is fixed to gold at whatever price. But you plebs can't cash in your yuan for gold at the central bank. So I think that's probably the initial way in which they'll try and stabilize things. But if that's really going to work long term, then they're going to have a proper gold standard, and it's not too difficult to do. But I think we've got into a situation where everyone wants to just hold on to their gold. That's what's got to change, because gold has got to be used to secure the value of credit. You can't just hold on to it and say, well, I'm out of credit. I don't want credit. I'm holding on to my gold because I don't want credit. You've actually got to use it to stabilize credit. And that, I think, is eventually where China goes.
In the interview, Alasdair Macleod says most economists misunderstand the difference between money and credit. He argues that gold is rising due to a physical supply squeeze, not just fear. Macleod notes that silver is undervalued as a monetary asset, and its role is likely to re-emerge during a credit crisis. From a technical perspective, Macleod suggests China has been suppressing silver prices by releasing cheap reserves. Macleod declared, "The days of that suppression have probably come to an end," suggesting that China's strategic silver acquisition program, initiated in the 1980s, has likely reached its conclusion. He pointed to the People's Bank of China's mandate to manage the nation's precious metal reserves, a mandate he believes has been used to justify the clandestine accumulation of silver. With silver testing strong support, he views a potential bullish breakout as bearish sentiment peaks. The price of silver advances to near $30.50 during North American trading hours on Tuesday. The white metal strengthens as its safe haven appeal has increased, with traders becoming increasingly concerned over the outlook of trade relations between the United States and China. Let's get back to the interview.
The macroeconomic community, which investment managers and the whole system are all part of, doesn't actually understand the difference between money and credit. The closer they get to it, perhaps is, well, gold is rising in times of trouble or something, but they don't really understand why. The reason that gold is rising, basically, I think, is because there's a squeeze on the market. It's a squeeze on the market because there is just not enough bullion, if you like, to support the huge, great mountain of derivatives. And that's beginning to topple over. I think when it comes to silver, of course, we all look at silver as not as a monetary asset, but as an industrial asset. I mean, everybody's been talking about the supply deficit that's over the last 4 or 5 years or however long, surely that's got to come through because silver's got this quality, that quality, and everybody wants it. So why isn't it going up? We should buy it, and it's sort of thing. But I mean, they're not looking at any monetary use for the currency. And I think as proof of that is the gold-silver ratio has fallen from when it was used actually as money, small change under the the British. Well, I say small change. It was up to 40 shillings in under our old gold standard. It was legal tender up to 40 shillings, which of course now looking at a sovereign which was, there's the equivalent of two sovereigns, so that's 1,200 quid's worth. So, which is interesting. But I mean, the point is that at that time, the gold silver ratio was in the order of about 15 times whatever, and now we're 100 times, which tells me that there's absolutely nothing in there at all in terms of pricing it as money, if you like. It's got no monetary role as far as the markets are concerned. Now, that's not entirely true as far as we're concerned in a credit crisis. And so I think that moneyness, if you like, is going to begin to shine through at some stage. And in that article, which I published today, looking at the markets, I thought, the technical situation actually looks very, very good if you look at it. I mean, if you've been holding silver, you may as well have held copper. They've done exactly the same thing, fallen out of bed big time. And you think, oh, God, that hurts. But actually, if you look at the chart, it's just come back and it's testing, it's tested a support area, which looks like holding, like the top end of a 4-year consolidation. And any chartist will tell you, well, this all looks good, it's intact, and it looks like it could be off to the races. So we'll see. I think silver is very interesting. I mean, when everybody else is so bearish, it's someone once described it as a puke point, which I think is a sort of fair description as far as most investors are concerned. They feel absolutely sick with the performance. That is the time when you buy. The Silver Institute knows when it puts together its tables is the sort of strategic reserves. Now, China, I know, has built quite a strategic reserve, and I think they use it to try and control the market. There is sort of evidence that that is the case. Now, if I'm right, then there comes a point where it's absolutely pointless them throwing cheap silver onto the market to try and keep the price down. They may as well hold on to their reserves. And I think we may well be seeing that point. Now, if that's right, then the moment China is out of the market, I mean, the price, I think, should take off. So it's going to be interesting to watch.
The world may not return to a gold standard, but make no mistake, the kings of tomorrow are already buying the king's metal today. The old adage that whoever holds the gold makes the rules is true today, just like it was 5,000 years ago. With global central banks and sovereign wealth funds increasingly moving towards gold, how does shifting away from the dollar reshape the global monetary system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.